All right, good morning, everyone. Let's get going. Okay, last night's session in the States, new all-time highs, baby. S&P taking out all-time highs and doing it in a bullish fashion, finishing the day at the highs of the day. And really kind of just drifting up the entire session. I think every time I looked throughout the night last night, we were up about another point and a half. We did have some big data out yesterday out of the States. We had quarter one GDP, which came in with a 1% contraction. The expectation was for 0.5% contraction, but we obviously missed to the downside on that. I mean, the only reason, for that data to be so poor, or one of the main contributors was simply the weather. We knew the data wasn't going to be great. We knew throughout the month that that all the data pieces were going to be inaccurate just because we had one of the worst weathers in the Northeast in history in the States. So, I think the market just kind of totally absorbed it. They weren't too worried about it regardless what it came in as. We saw jobless claims that came in at 300,000, which is the lowest figure, I do believe, since 2007. Again, and we continue to see the numbers on jobless claims and really all the other numbers, the durable goods orders, all those kind of things, continue to come in better than expected. So a very positive, result out of that. And I think, it's a more forward-looking number, so the market just shook off the Q1 number. We've also got the M&A news with Hillshire Brands. Now Tyson Foods has jumped in on the back of the initial bid from competition there and trying to poach out from under them. So there's a lot of M&A that's starting to come through the market at the moment. That's also a very bullish sign. So I think we've just got to keep these things intact. I mean, there's a lot of reasons to be bullish, there's a lot of reasons to be bearish at the moment. Asia, we had a bit of a mixed session. We were down across the board about an hour and a half ago. We've had a turnaround there, and the Hang Seng's gone positive. The Shanghai's also gone positive, and it was down more than 0.5% at one point. We saw, just mixed action obviously across the board there. We had Tencent that was up earlier as much as 1.2% this morning. It's actually down at the moment, but that thing's kind of seesawing above and below flatline. Some of the tech stocks traded all right in Hong Kong. Casino stocks were really strong there. In Australia, we had some of the diversified miners that were lower. Again, we continue to see the mining space under real pressure. We did have that kind of rallied into the end of the session in London last night, but the volume is incredibly light. There's so little that you can take out of that at the moment, and that goes for most all the stocks in our index as well. You have to be really, really careful out there with the volumes as low as they are. Not to believe it too strongly simply because the volumes are just so light. So we've seen iron ore prices, they dropped to a 20-month low now. We had Goldman Sachs come out a couple of days ago, reiterate its $80 price target on iron ore for the year, and they actually upped their forecast for the surplus in iron ore on the year. So definitely not good things coming out on iron ore. We saw Kumba really get hit hard yesterday. And then Japanese equities kind of struggled, I think, probably on the stronger yen overnight, probably rallying a little bit on the risk aversion out of treasuries. All right. Really, really interesting chart here out of Zero Hedge. Try to stay away from Zero Hedge as much as possible, simply because they're just perma bears. But we do have. This is something that we've been talking about for probably the last month, and the disconnect in markets and how we've. The correlations in asset classes have just totally broken down. And this is a perfect example. We've seen, you can see how closely the 30-year, and this goes for the 10-year as well, U.S. Treasury yield, usually track the S&P 500. There's a very close correlation, or inverse correlation, if you want to call it, depending on whether you're talking about yields or the actual bond prices, with the equity market. And we've seen a total breakdown of that recently, and I mean it's really just gone in the exact opposite direction, going back toward the beginning parts of the year. Now, I think that this is really, really important. I mean, if you look at the same sort of chart up at the top there in 2011, that really kind of signaled the sell-off to us when we saw bond yield or bonds rallying, yields obviously falling. It took a while for the equity market to play catch up. Most people talk about the fact that the bond market is the smarter of the two markets, and usually when they start to go in different directions, the bond market's right. Doesn't mean that it's going to come now. It could last for a couple more months. But this is something that I think is very, very interesting. One thing to note is, as of about a week ago, 90% of retail portfolios that were positioned in U.S. Treasuries were positioned short U.S. Treasuries, and that probably is not going to go in their favor until the balance of those trades starts to swing back closer to neutral. We also saw, I read last night, 91% of equity portfolios are short the S&P 500, or futures, retail future accounts are short S&P 500. So S&P 500 probably also not going to come down until those guys get squeezed out. So that's very interesting. I think if you could simply get minute-to-minute statistics on how people are positioned, you'd probably make more money than anybody on the planet on trading if you just traded the converse of that. So that's those are really telling statistics. All right, and corporate action today, absolutely nothing. We've got Life Healthcare that goes ex-div on Monday next week, 63 cents. We're looking for market data today. We got a hell of a lot of stuff on the board. We did have the jobless rate out of Japan that came in line. We also had the CPI numbers came in line. Industrial production came in a little bit soft. We saw money supply. We've got money supply here, or had a money supply here. Sorry, I didn't see it yet. We had retail sales in Germany as well as private sector credit. At the open, Spain's got CPI, Italian CPI at 10, and we've got a trade balance here at 2. We've got the budget at 2. So those are going to be probably important to watch. And then later in the States, we've got personal income, personal spending, and University of Michigan confidence. So keep an eye out for those data points today. Probably, the ones to focus on are going to be the South African budget. Other than that, probably not a whole lot that's going to move the markets too much. All right, let's get into the maps. All right. I think today is kind of the day of the bull flag. There's this pattern just kind of presenting itself over and over in our markets as of yesterday. All these stocks that kind of have been moving sideways for the last however many weeks. Some of this is probably more of a descending triangle than a bull flag, but whatever. You've got Pick and Pay here breaking out to the upside, and probably one of the most hated rallies on the JSE in a while. A lot of guys short of this one, and it's really closing the gap lately between Pick and Pays and the ShopRites of the world. So I think this is really interesting. I think a hell of a lot of people have that trade on, things like that, long ShopRite, short Pick and Pay, and it's not really working out for them at all. So just be careful out there with this one. I think there's still a lot of short interest out there, breaking out to the top of this pattern. We got Supergroup, same sort of thing, bull flag. This one's definitely looking more flaggish than the Pick and Pay chart. But you can see here really breaking up out of the outside of the flag because of yesterday's session, and really just a beautifully symmetrical chart here. Came down after we broke out, pulled back beautifully to test the exact level of support around 2880, exactly where we broke out from, and then yesterday exploded to the upside, probably looking to take out the highs in the next few sessions if conditions allow it. Foschini, also a big reversal yesterday after they came out with earnings. Nothing spectacular, but enough to kind of quell some of the worries. Same sort of thing. Also pretty nicely symmetrical here. Came down, tested support. We did get actually well below 108 yesterday's session and the day before as well. And we managed to just kind of hang on to it on a closing basis. And then yesterday we really rocketed higher. This thing's definitely turning into a bullish pattern after really looking overly bearish for a significant period of time. And I think that we can probably take out the highs as well if nothing comes in to really stop the momentum. Woolies also flagging out here a little bit, and this one, it's kind of broken out. It's kind of a little bit borderline, but either way you look at it, I mean, this pattern's starting to shape up as really bullish. It just freaking refuses to come down. I mean, yesterday we were below 76 again in the early afternoon session, and then the thing manages to close all the way up at 76.98. It just absolutely refuses to go down. It's really probably been the most absolutely rock solid retail share in the past couple of weeks. Yeah, I mean, this thing's, if you look at it in a little bit of a longer term setup, you can see here this, the breakout that happened here is really significant. So this chart's definitely looking bearish longer term. So you got to be careful of this one in the next couple of sessions if it pops out the top there. All right, a couple that we did talk about yesterday, and we kind of really got it right yesterday for the first time in a while, coming in bearish on some of the mining stocks and talking about how they were really set up for a proper fall. We showed this one at below 252, saying that yesterday or the day before yesterday we actually got a close below 252, and if we started to drift a little bit lower, it was probably going to get hammered. It really fell hard when we traded down to about 336, I believe, and bounced up a little bit into the close. But either way, I think what's important about this is it's a real significant a breakdown. I think it's significant in terms of what we're looking at in the global scope of things, and the sort of sectors that are going to continue to do well, and the sectors that are continue to struggle. This one showed us a couple days of strength maybe 2 weeks ago, and really just rolled over after that. We've got about a $50 downside on the breakout of this target, which is going to take us down to around $300 on the price target on the technicals here. And then the last one we're going to show is Impala Platinum, which also gave us a real confirmation yesterday of the breakdown. When I draw it, I'm going to cut out that little bottom there because I'm going to just go from the closes. And you can really see, I mean, we put in this little consolidation over the last week, maybe under the breakdown right here, sort of around the 115 level. And yesterday we finally really dropped out the bottom of all of that consolidation, and as you see, we're looking to take out lows that are very close to this level. 109. Let's just have a closer look. 109.19 was the previous was the closing low for going all the way back to September of last year. And if we take that out, I don't see any reason why we can't trade all the way down to the lows of probably the last 5-10 years. Let's just have a look at the 5-year here. There's a 5-year lows are down in the mid 80s. I don't see any reason why we can't trade down there. As we drop out, if we can drop below the recent lows, I don't see any reason why we can't get down there. That's it for today, guys. Thanks a lot.